Hi, this is Eric Hess with the Encrypted Economy, and today we're really excited to have Jonathan Wu, a crypto analyst, on the show talking about stablecoins. Now, we reviewed the different types of stablecoins and the collateralization for them, and went on to algorithmic stablecoins and how they operate, and even covered the more famous failure of Titan most recently with algorithmic stablecoins. Now, one of the things that we also focused on, or I spoke a little bit about, was Tether. In the podcast, I talked about Tether being 76% commercial paper. Actually, that was factually inaccurate. There, shortly after the podcast was done, like the next day, the general counsel and the CTO of Tether did an interview with CNBC. Also, the general counsel had published a blog post where they disclosed the reserves. Now, I might have pulled this off an earlier version, but in any event, the commercial paper is 49.6%, of which during the CNBC interview, Stewart said that, or Stewart being their general counsel, said that the overwhelming majority of that 49.6%, he didn't specifically reference that percentage, was A2 rated, which suggests that the balance is not or worse, so still an unrated risk. 18.4% is fiduciary deposits, which doesn't necessarily mean cash. There's actually only 2.9% cash. So I didn't delete this from the podcast when I stated the 76%, because essentially all the concerns about unrated paper and obligations being part of what they claim to be stable is not true. Interestingly, the interview itself with CNBC, probably a lot of people watching it probably would think this may be a future legal exhibit or reviewed by different regulators as they contemplate Tether either now or in the future. Interestingly, the same day that Tether did this, the SEC released Chairman Gensler's speech to the American Bar Association, where, among other things, Gensler noted that stablecoins that were backed by securities would themselves be deemed to be securities, commercial paper, securities. Thus, Tether arguably would be a security. This would also, interestingly, extend to USDC, which is considered to be more stable. They have 61% cash equivalents, again, compared to 2.9% for Tether. But a component of the USDC reserves are bonds and 9% commercial paper. So does that put them in the category? Who knows? Certainly, I don't know if I'd be as concerned about that if I were a regulator. And of course, the same day as well, Paxos, I think maybe in response to the CNBC interview, maybe they just had it ready to go, but they issued a blog themselves and they compared, they said, hey, listen, we're 96% cash and equivalents, 4% US Treasury bills. They didn't say, they obviously would meet Gary Gensler's test. We're regulated, we're based on cash, we're stable. Why not us? Why are you looking at these other guys? So pretty compelling back and forth there on the stablecoin front. And Paxos may, with the regulatory focus on it, have the upper hand in adoption. Tether still has the bulk of the market. Question is for how long, given their issues. So one other thing is during this podcast with Jonathan Wu, I was using my headset microphone. I didn't know it was turned on, which was up away from my mouth, but I speak pretty loud. The microphone was pretty good, not as high quality as this microphone, which is my podcast microphone, but hopefully I think it's still sufficiently clear. So apologies for that. Lastly, listen, if you enjoy this podcast or the other podcasts that I've done, share it. Tell people about it. Let's get the encrypted economy in more people's ears and drive up that user base. So with that, I give you the encrypted economy with Jonathan Wu, and thanks for listening. Welcome to the Encrypted Economy, a weekly podcast featuring discussions exploring the business, laws, regulation, security, and technologies relating to digital assets and data. I am Eric Hess, founder of Hess Legal Counsel. I've spent decades representing regulated exchanges, broker-dealers, investment advisors, and all manner of fintech companies for all things touching electronic trading, with a focus on new and developing technologies. So this is Eric Hess with the Encrypted Economy, and today, really excited to have Jonathan Wu on the show. He's going to be talking about stablecoins and algorithmic stablecoins, and Jonathan's been doing a lot of posting with regards to the operation of algorithmic stablecoins. He's amassed quite the following, and he's provided some very insightful content. So, John, welcome to the show.
Thanks, Eric. Great to be here.
Excellent. So, like any other show, the origin story, how'd you get involved in crypto and what was your background before?
Oh boy, let's see. I was a TradFi guy before, as the crypto folks like to call finance 1.0.
Yep.
So did a whole career in consulting, private equity, went to business school. And then after that, started my own startup, shut it down in February, and had a couple friends in crypto, and they said, you really got to pay attention to this. And as soon as I started diving into DeFi, decentralized finance, I became instantly addicted, and I've been in free fall down the rabbit hole ever since.
like many of us. And so was there and you can make this a crypto response, or you can make it really any response, really just a chance for the audience to get to know you better. Personal event that shaped your values, your goals, just really anything that you think is maybe a little more insightful as to what makes you tick.
Yeah. So, definitely for crypto, I think it was a rejection of permission structures that I've been in, my entire life. So I oftentimes describe myself as a retired stamp collector. I was all about the status and the esteem and, the halls of power. And I think crypto is this beautiful thing where you see protocols like Uniswap, where it's a single person, Hayden, just sitting down and saying, hey, I think there's a better way to build a market, and in a totally permissionless manner, writes a couple lines of code, and now Uniswap does billions of dollars of volume. So I thought that was really appealing to me, coming from potentially corrupt and inefficient world of which I was a beneficiary. So just that notion was incredibly powerful to me.
Excellent. So, the podcast, we typically start off at a high level. I call it the horizontal layer before we go a little more vertical. So we're talking today about stablecoins. Let's just take a step back and let's go through what is a stablecoin.
Yeah. So, a stablecoin is just any crypto asset that is pegged or otherwise non-volatile. And so the notion is to find a decentralized currency, a mode of exchange that roughly tracks purchasing power. And so bad currency would be something that either inflates or deflates rapidly, and it's very hard for you to buy a basket of goods over time with that a relatively stable amount of that currency. And so a stablecoin is just a way to create a currency that roughly allows you to transact in a predictable manner.
Right. And let's compare and contrast that with stores of value, and why stores of value from a monetary perspective don't have the same characteristics.
Yeah, a store of value is oftentimes a lot less liquid. And so, classic store of value and a couple stores of value in the normal world, equities, gold, real estate, they're not very liquid. And not only that, but they're highly volatile. And so what you want to be able to do is take a currency and be able to, purchase a relatively stable basket of goods with it. And it's hard to do so with highly liquid assets. I'm also a landlord, came from the real estate world at some point in my meandering career as well. And I can tell you when you really need it, it's hard to liquidate or extract value from your real estate.
Right. And this concept of liquidity is going to wind its way through our podcast. So I'm taking the time to sort of lay the foundational elements. Now, maybe I'll get some haters out there for this, but I think at least for the moment, Bitcoin has sort of lost the argument as being potentially that stable currency, because, when you go from like 65,000 to below 30 within a relatively short period of time, how do you transact for that in the real world? So I think a lot of the discussion, it has certainly put even more spotlight on stable coins, and what they do has shifted to stable coins, because those would be a more, to your point, liquid, but not only liquid, but reliable liquid form of currency.
Yeah, exactly.
And so how does inflation factor into the whole stablecoin equation?
Yeah, so inflation is just a loss of purchasing power. And so it just so happens that our central banking entity believes that a small, moderate amount of inflation is necessary for overall system stability. It's not clear how the crypto universe is going to consider inflation. Right now, we actually still outsource the notion of stability to the US central bank. And so most stable currencies in crypto are pegged to the US dollar. And so you can have monetary policy within crypto that maintains price stability to the US dollar, but ultimately we're trusting that the United States has the best monetary policy when it comes to purchasing power. And so I would say that that is an unsolved question. There are certainly crypto native non-pegged stables like OHM, but they are in their nascency and certainly far less popular than US dollar and fiat pegged currencies.
Right, and you can certainly make an argument too that there was a market for stable coins even before stable coins. I mean, you look at euro dollars. You know, the euro dollars was created because of the insatiable demand for US dollars. So you created US dollars that are or euro dollars, which aren't even regulated, much like stable coins. Although, you know, a lot more regulatory attention is now being turned to stablecoin.
Exactly. And like it or hate it, most of our spending is still fiat denominated. We still live most of our lives in the real world. And so until the point that our spending shifts to the metaverse, we're still going to prize, the basket of goods we actually consume. And that's why CPI is still relevant, because we still drink milk and eat eggs and fill up our cars with gasoline.
That's right. And we want that stable currency to know that we can buy it, right? So let's start to break down stable coins a little bit, because now we sort of covered it generically, but like many things, it's not that simple, right? So there's pegging, there's collateralization. I'm going to turn it back to you to kind of, let's walk through that a little bit.
Yeah, I mean, the simplest form of a crypto stablecoin is just a fiat-backed, fully reserved currency. And so the classic examples of that are USDT, Tether, and USDC. And the notion is very simple. I have $1 in a vault somewhere, and some central trusted entity tells me that there truly is $1 in that vault. And against that dollar, I issue a digital representation, which is the crypto asset version of the currency. And so one USDT is $1 because it's always backed 1-to-1.
At least theoretically.
Theoretically, and I won't address the Tether FUD. I'm not an expert on it, but happy to talk through that.
There's probably some argument, and we'll get into it a little bit when we talk about partially collateralized, right? Because if the notion of fully collateralized is 1-to-1 US dollar, Tether, of course, in their white paper stated they were 1-to-1. 1 USDT equals 1 US dollar. Anybody who's been following crypto even mildly knows that that is not the case. A few months ago, in conjunction with a settlement with the U.S. Attorney General in the District of New York, they basically disclosed, as part of the settlement, they agreed to be a little more transparent about their formerly non-transparent proof of reserves. And shockingly, they disclosed that they were 76 backed or reserved with unrated commercial paper. Now, they didn't use the word unrated, but hell, if you were like an A plus or AAA or AA or what have you, you would certainly state the ranking of that paper. But they just simply said 76% commercial paper, which raises a lot of question as to what kind of commercial paper, since many in the community don't even know how they've been acquiring it in the quantities to support like a $60 billion float. Most people don't even know that they've been players in the market. So then people say, oh, intermediaries. But one of the challenges with Tether is the argument keeps getting worse and worse every time they sort of abuse the trust. And I'm just going to throw one other zinger before we move on, because I'm not trying to go down the rabbit hole of just Tether, but even their bank, which holds all their reserves, Deltec, went on the Lorishin Unconfirmed podcast back in February when this Crypto Anonymous went on Twitter, or actually, I guess, elsewhere as well, and started breaking down all the issues with Tether. And one of them was that they looked at the reserves for Deltec and didn't think things matched up. Their CEO went on Unconfirmed and stated that he had, or Deltec had confirmed, and they used the word trust and verify, that they had enough cash and cash equivalents after they conducted an audit. And he clarified what cash equivalents meant: T-bills and time deposits. Well, unless things dramatically changed between the end of February and the disclosure of the reserves, apparently that audit couldn't have been very solid. So the challenge with Tether is that they have, unfortunately, a history of sort of abusing the trust that the market has put into it. And I think the regulators are increasingly concerned that this thing is a lot less stable than all would desire. So, I think the market is ultimately going to have to do a reset to a lesser dependency on Tether, or they're going to have to agree to some sort of settlement where they regain that trust, maybe through a more stricter audit regime, because obviously the current scenario really can't continue. So that's my little mini Tether podcast within the larger podcast. So we're shifting back to the main podcast. But I have a lot of views on Tether. I've commented publicly, social media and otherwise on it. So I don't think we can really have a episode on stablecoins without talking about the Tether elephant in the room. But I think, and just to sort of reset for the listeners, this podcast isn't about a stability issue that exists within Tether. It's about understanding the structure of stable currency within digital stable currency and the different mechanisms that we use to set it, and is really almost like a chance for the listeners to understand the frameworks that, whatever happens with Tether, what even happens to the crypto market short term, stablecoins are clearly here to stay, because to do anything in the digital ecosystem, you need a stable currency. So John, with that not complete tangent, but with that little offshoot, we're going to go back on the highway here and keep walking through the description of, fully collateralized, partially collateralized, and non-collateralized stablecoins.
Yeah, and actually the Tether case is informative, because why are we uncomfortable that some of the value is held in commercial paper? The face value they're telling us is $1. So why are we uncomfortable? Because there is some underlying implied volatility to holding commercial paper versus US dollars. So that becomes really important when we talk about our next type of stablecoin, crypto asset collateralized, because we can't collateralize stablecoins one-to-one with crypto assets. And why? Because crypto assets have extremely high implied volatility. And so you see certain protocols like MakerDAO offering a minimum collateral ratio of 150%. And so you need to commit $1.50 of volatile assets to generate $1 of stable assets. And that makes perfect sense, because the volatile assets go up and down. And so you never want to be caught in a situation where there's less than $1 of backing for every dollar of currency issued. And that's the Tether problem, right? If you're at $1 of face value collateral against $1 of issued currency, well, you would hope that the dollar collateral has absolutely zero volatility. Ideally, it would be cash or cash equivalents like treasuries. That's as zero risk an asset as exists in the world today. But if it's commercial paper, that means that actually there's a chance that in a tail risk event, like the failure of the underlying corporations against whom the debt is issued, that you might become under collateralized. And then that becomes a problem, because now your dollar is backed by 90 cents or 80 cents or 70 cents. And so the solution in the cryptoverse that Maker and others have committed to is just taking more collateral so that there's a little bit of a buffer between the dollar of issued stable and the actual underlying value of the collateral. And more importantly, if the collateral value ever races below the minimum required collateralization ratio, in Maker's case, third parties go and liquidate the collateral and ensure that the protocol is stable and there's always more than $1 of face value assets for every dollar that's issued.
Right. As opposed with Tether, if it starts to go below, there is no automated, it's not algorithmic. In Maker, I believe there's a whole incentive model that's also algorithmically determined, right? But in the case of Tether, I mean, I'm sure they use some things on the back end to try to liquidate. But the question is in the case of a bank run, how would they create enough dollars to satisfy the obligations? So
correct. And it's important to note also that it's almost impossible to have a decentralized, fully fiat-backed stable currency. And so if you think about USDT and USDC, we're really trusting central organizations and really giving them our faith that when they say there's $1 in the vault, there actually is $1 in the vault. The nice thing about Maker and other decentralized stable protocols is we can kind of always see on chain how much collateral is outstanding. And not only that, but third parties can step in situations where the Maker protocol or other protocols like it, like Liquidity, get into trouble, where the collateral starts to dip below the minimum collateralization ratio. And there are liquidation mechanisms that we can all kind of see transparently. And so that's kind of the goal of crypto, right? Is to move away from having to trust third party that could be corrupt, could obfuscate, the actual source of collateral, that ultimately has to be given the faith to audit and observe and custody the actual collateral value that's sitting behind the currency.
Right. And to be fair, even the US dollar itself, I mean, it's not fully collateralized. It's backed by the full faith and credit. But the more you issue, it's really dependent upon others valuing that asset. And if they stop valuing that asset, then interest rates have to go up in order to get them to value that asset again. So it's also important when you get into the stablecoin discussion to sort of, there's a bigger hole too, which is, USDT is often the stable coin, but USD is more stable, but these, particularly when they're pegged one-to-one, there's still a dependency on the underlying US dollar as well.
Absolutely. So then I think it's worth moving on to under-collateralized stablecoins. And so we talked about over-collateralized stablecoins that are backed by volatile assets. And we had talked about how it makes sense that you would need 150% plus of face value. In Synthetic's case, I believe the number is 500%. It's like significantly over-collateralized. And that's as a safety mechanism, right? But it kind of begs the question, if you're 500% over-collateralized, why not be 10,000 times over-collateralized? Why not have $1 million of collateral for every dollar of currency? And I think when you take it to that extreme, it becomes very obvious that you'd have to suck up a huge amount of the world's capital just to create the currency. And so the holy grail is kind of to have all the decentralization of a volatile crypto-backed stablecoin, but also at the same time be capital efficient. And this term gets thrown around a lot, and all that means is to just have less than $1 of collateral behind every dollar of currency that's issued. And so there have been a lot of theoretically brilliant, but practically to date unstable attempts at creating what's called an algorithmic stablecoin. And what an algorithmic stablecoin is fundamentally something that's under collateralized. And so it has less than $1 of collateral for every dollar of currency that's issued, and retains its peg to the US dollar via a clever stability mechanism. And a bunch of these stability mechanisms have been devised. One is the seigneur's shares model, where when the currency is over $1, essentially what happens is you can sell the dollar when the stable currency is worth more than $1. What you want is to create more volume of that stable currency. You want to increase the supply. And so increasing the supply means the central bank entity needs to mint more of the stablecoin. And in order to mint the stablecoin, you commit a mix of collateral, and then the central entity increases the supply. The increase in supply should bring the price of that stablecoin back down to $1. And so that's the kind of pegging mechanism. And so through controlling supply and demand, like a central bank does, these algorithmic stablecoin protocols kind of maintain their peg 1-to-1 to the US dollar.
Right. And when in the seigneurage shares, when it drops below $1, they'll often issue, like I think Basis will issue Basis bonds. So when those bonds get priority, if and when it goes back above $1. So it's sort of like, in many ways, it's designed to resemble what the Federal Reserve might do, in trying to maintain the value of the currency. But is that basically the mechanism for the seigneurage shares?
Yeah, there's a dual token model where there's the actual stablecoin and then there's an equity shares component. And the idea is anytime the stablecoin is above $1, anytime a new stablecoin is minted, the profit goes to the equity holders. And so that gives equity holders a reason to hold the shares, because if the stability is above $1, the shares accrue value. And then when the stablecoin is below $1, in Basis's case, you can issue bonds against the shares in order to buy the equity at a discount. And so ultimately the whole mechanism is premised on the notion that the stablecoin will continue to be used, it will continue to be distributed, it will continue to fluctuate above and below the peg, and profit will accrue to equity holders. And so the difference between the actual circulating quantity of stablecoins and the value of the collateral is the value of the equity. So the equity kind of stands in as collateral, and you're kind of bootstrapping value out of thin air because it's all premised on the faith that the equity in the actual organization has value.
So with algorithmic stablecoins, how do algorithmic stablecoins, I guess we'll talk about what they actually are and how their mechanism for achieving that stability differs from what are considered not algorithmic stablecoins or your fully collateralized or what have you, or pegged.
Yeah, the algorithmic portion of it is just a way to return the peg back to one stablecoin equals $1. And so there are a variety of mechanisms, the seigniorage shares model being dominant right now. And that was adopted by Frax and Basis and recently with Iron Titan, which saw a significant failure. And the seigniorage shares, again, are just a mechanism to plug the gap between actual underlying collateral and the value of the currency, if that makes sense.
Yeah, would you say, I've heard it described that it's more akin to like more active market making with regards to algorithmic stable coins as opposed to necessarily mint and burn, which you might do in another model. The algorithmic stable coins, it's more of an active market making, going out and buying or selling to moderate accordingly.
Yeah, there are multiple models, but if you think about the monetary policy as similar to the Fed's open market operations, when there's too much of the stablecoin, aka the stablecoin is below peg, you want to incentivize destruction of supply. And when there's too few, aka the stablecoin is above the peg, you want to incentivize the printing of more. And so if there's a central entity that can go out and purchase stablecoins and destroy them when it's below the peg and issue more when it's above the peg, that's kind of what the protocol is aiming to do.
Right. So like with the basis bonds, for example, basis bonds are, I guess, swapped out for the basis token, right? The stable coin. And then those coins, when they come back in, they're burnt to destroy them. And that's the relation of the bonds to the coins. They're basically issuing bonds to burn coins.
Correct. And the commitment to the bondholders is they'll be the first to get paid if the peg ever goes above $1. If the peg ever goes above $1, the protocol will create more supply, and the profit of creating that supply will go first to bondholders and then to, basis shareholders.
Great. So there've been, so algorithmic stablecoins, I guess, other than the seigniorage, I understand even the seigniorage model has had its challenges. But maybe we can talk through some of the challenges, and I think you're certainly an expert with some of the ones that have been most in the news lately in the algorithmic front, primarily Titan, but there's also been Fay and Frack. So maybe you can pick whichever one you want to talk about first, or just leave them all together.
Yeah, we can talk about Fay. Fay is actually not a seigniorage model. Seigniorage meaning just the difference between what it costs to create a currency and what the actual face value is. The way that Fay attempts to maintain peg, essentially twofold. One, when the stable coin is above the dollar peg, they rely on arbitrageurs to arbitrage the stablecoin back to $1, essentially by selling the stablecoin for $1 of reserves. On the other side of things, the way they try to maintain the peg is by penalizing the selling of the stablecoin when it's below the dollar peg. So let's say the stablecoin is 97 cents on the dollar. What Fay does is makes it very hard for you to sell without a deep penalty. And the penalty has a geometric relationship with the distance from the dollar peg. And so at 97 cents, I believe the penalty is 9 cents. So the dollar minus the 97, which is 3 cents squared. And the deeper it goes away from the peg, the higher the penalty is. What that means is basically it reduces the amount of sell pressure on the stablecoin in order to incentivize more buying. And so they're trying to disrupt the supply-demand dynamic to get more people to buy the stablecoin, restrict selling, and that should push it back toward the peg. Now, the problem with that is if there are just a bunch of sellers who want to sell and now they're handcuffed to the desk and they're not allowed to sell, it's not as if the selling demand goes away. They still want to dump the stablecoin. They just can't really do it right now because they have to take on a really huge penalty to get rid of it. And so the problem arises when you have a significant sell-buy demand difference, and the stablecoin just cannot get back to peg naturally. And so Fei has like an emergency mechanism to basically force the stablecoin back to the peg called a reweight. And the reweight essentially is just pulling all the liquidity from the trading market, which they control, rebalancing the supply, and then re-injecting the liquidity. And that forces the peg price back to $1. Unfortunately, what happens is all of the sell demand that was kind of had their hands chained to the desk and couldn't sell immediately want to sell as soon as the peg goes to $1. They want to redeem the stablecoin for $1. And when that happens, the peg then drifts back below $1 again, and you kind of restart the cycle. And so the fundamental problem with stablecoins in general is there needs to be a balanced amount of supply and demand. There needs to be sufficient use case for the stablecoin for people not to want to be net sellers. And that means having integrations with other protocols. That means having an internal use case within the protocol itself. That means being able to buy something, right? Being able to buy something with a Fei dollar, being able to buy something with Fracks, being able to buy something with DAI. And that's something that I think DAI has done a really good job of, is DAI is actually usable. You can actually take it around the crypto ecosystem and you can use it and spend it and buy things.
Right. And so I guess as there's a suppressed demand for buying crypto assets, like we're currently in, some people might call it a mid-cycle correction, some people might call it a bear. But in that environment, generally you anticipate there's less liquidity unless it's an active bear market down, and there's less demand for the stablecoin. So what happens to these issuers during that time? Does it put a lot of pressure on those that other than protocols like Maker or USDC, where they've already got a significant market share so they can weather the storm? What does it do to ones that are more nascent, developing, maybe don't have the same market share?
As long as the change in demand and supply is incremental, these stability mechanisms have a way of returning the price to the peg. I think what happens, the troubling case is the edge case where there's like a sudden spike in sell demand, where everyone really, really wants to get rid of the stablecoin. And so Iron Titan might have been a good example of that, where there was a period where the equity holders decided that the equity just wasn't worth very much. And same with the holders of the stablecoin. And they sold both concurrently. Now, due to their stable mechanism, which every time the stablecoin is under $1, you can redeem it for a mix of collateral and equity. And so the protocol essentially issues equity against redemptions. The problem with issuing equity is the more redemptions there are, the more equity you have to issue. And the more equity you issue, the less the equity is worth. So you can see where this is going, where as I issue more and more equity to satisfy redemptions, the value of my equity falls and the more equity I have to issue. And so the supply of equity tokens that I have to issue essentially goes parabolic. And what you saw happen with Iron Titan was it was trading at a value of $60 on the day that it failed. And by the end of the day, it was trading at billionths of a dollar, 15 billionths of a dollar. And that's due to this very reflexive nature of their stability mechanism. And that was an incredibly sudden move. So a lot of these stablecoin protocols are prepared for incremental shifts in demand, but they're not prepared for sudden, mass exodus from the protocol.
Right. So like in the case of the Fei, you'd have to have an awful lot of conviction that the market was going to start selling down hard to be willing to take sort of a 9-cent penalty for selling at 97 cents. That's probably a leap that a lot of traders wouldn't be so inclined to make. But Iron Titan sounds like they didn't have that same mechanism. They didn't have the same mechanism to sort of moderate or disincentivize the fall.
Yes, exactly. And ultimately, if you think about what a non-backed currency is, like the US dollar or algorithmic stables, it's really based on faith, right? As with the US government, it's backed by the full faith and credit of the United States. If we all, as Americans, decided to lose faith in the US dollar and all 340 million of us decided to switch to the euro or switch to the yen, the US dollar would also fail. We just don't think that's going to happen. And we look at each other and we say, you believe in this, right? Oh, okay, great. I believe in it if you believe in it. And that's why the US dollar continues to have value the same way Bitcoin continues to have value. Algorithmic stables have to bootstrap themselves to that point where people can look at each other and say, you have faith this will, remain a dollar, right? Oh yeah, I have faith in that too. And if we all collectively have faith in both the value of the underlying currency and in the seigniorage case, in the seigniorage shares, then it will stay near the peg, because if it's below, I'm incentivized to believe that it'll go return to a dollar. And so I will demand more of it, knowing that it'll go back to a dollar. And if we all don't have faith, then it fails. And so I think this is the trouble with algorithmic stables. You have to get to a point of mutual faith among the entire community before you can truly say you have price stability. And that means being adopted, having use cases, being a mode of exchange.
What is Frack?
So Frax was one of the first seigniorage shares algorithmic stablecoins. And the idea with Frax was to be very, very incremental about letting the market decide how much collateral they needed behind every dollar of stables that was issued. And so the protocol actually began fully collateralized, one-to-one. The way that Sam Kazemian, the founder, designed the model was that every time the peg was above a dollar, the collateralization ratio would actually fall by 25 basis points, so 0.25%. And in this way, he thought the market could determine how much appetite for collateral they really had. If there was continuous demand for the stablecoin, the collateralization ratio would fall consistently. Today, it's about 70% collateralized, which means the market roughly said, we have appetite for it to be 70% collateralized, and the rest of it will be collateralized by the equity in the protocol itself, the seigniorage share token, or Frax shares. Anytime the peg is below a dollar, the collateralization ratio improves by 0.25%, so it goes up. And so in that way, kind of, if no one really wants to use this, or there's not a lot of demand for the stable currency, well, let's make sure there's more collateral behind it to improve faith in the system. If there's a lot of demand for it, then we can reduce the amount of collateral that's backing it. And so that was kind of the Frax idea, and it's been relatively stable, although total circulation is around $150 million, I believe, as of this recording. So it's not nearly as universal as some of the really big players like USDT, which has tens of billions of dollars in circulation.
And does Frack have the ability to continue to increase collateralization as the price goes down?
So Frax actually... Yes. So the way the mechanism works is it increases the collateralization ratio by 25 basis points for every hour that it's below the peg. And so if it is remaining below the peg, the collateralization ratio kind of creeps up over time. And the problem with Iron Titan was actually a Frax fork. And so they took a lot of the underlying mechanisms of Frax. And again, the problem with Iron Titan was because there was such a sudden failure, moving the collateralization ratio by 25 basis points an hour doesn't help very much if there's a 6-hour bank run where every single person who's an Iron Titan holder, decides to sell their holdings of both the stablecoin and the shares backing them.
Right. And so coming out of the Iron Titan issue, and I think even Faye had some of its challenges, although they seem to have moderated. What do you think the lessons are for algorithmic stablecoins going forward? Because there's been a lot of models. I've certainly read a number of papers, and the refrain is sort of universal, which is make sure you understand how this thing is actually operating before you invest in it, because you could get a surprise, and Iron Titan is an example of that. So where is the market for algorithmic stablecoins? Are we getting closer to, I guess first, what do you think the lessons are from from Iron Titan and others?
I think one of the lessons for both Faye and Iron Titan, they both issued a bunch of incentives to get people to purchase the stablecoin, which makes sense. You need to bootstrap adoption somehow. The problem is issuing one-time incentives is like giving someone a gift, like free money, right? A free prize or something. It only lasts for as long as they value that free prize. It's not really an ongoing commitment. And so I think the first trap that algorithmic stables run into is focusing too much on incentives and rewards to drive adoption. The type of person who will be drawn to incentives and rewards isn't really planning on necessarily using the stable for anything. They're just there to collect their free gift, and then as soon as they can, they'll dump the free gift on the market and walk away. And so lesson number one, bootstrapping adoption using rewards is a dangerous game. You'll certainly get adoption, but you could quickly get to a point where everyone wants to dump the currency as well. I think the second lesson is you just need forgive the pun, stable, recurring use cases for the actual currency itself. If I told you I was starting a new currency, you would say, great, what can I use it for? What can I buy with it? If there's nothing you can buy with Frax or Fey or Titan, then there's not really a strong reason for you to hold it in the first place. It's not a store of value because it is stable. It doesn't really actually, there's no value accrual to the actual stable currency itself. So you need a place to transact. And so I would say even more so than the trap of, issuing too many rewards, algo stables really need to focus on where can I use it, integrating with protocols where I can actually spend the stable to buy something.
Right. And it would seem, again, we're probably a number of years away from it really taking root, but where you have like these metaverses, it would seem that if you can plug into that early on to a successful metaverse, you've just locked the market versus maybe trying to get in now and compete with not so much USDT, because there may be actually an opportunity there, but USDC, MakerDAO or DAI, and some of these other stable coins. So interesting. And so what do you think? I mean, do you have any views on the potential regulation of stable coins going forward?
I actually don't have specifically strong views on stablecoins. I know Mark Cuban had called for regulation after the Iron Titan fiasco, but
because he got burned.
I can only imagine that's because, he had a personal stake in its success. I don't actually think that it requires a more complicated regulatory regime than the rest of crypto assets. I think in general we should not consider stable currencies to be assets, and so they probably should not be taxed every time they're transacted. Now, the nice thing about stables is they roughly are the same value, or should be roughly the same value in USD over time, and so the tax impact should be relatively little for using them to buy and sell. But they do have some volatility. They do kind of vary around their peg. The reason why these stability mechanisms exist is because the peg can drift. And so I can't really think of like the taxation nightmare. Imagine if you were taxed every single time you spent a US dollar, every time you transacted in the real economy. It just wouldn't be very stable.
Right. It would be definitely suppressing the ability to transfer the currency. I mean, the turnover on USDT is like 60 times in a year or something like that. I don't know. I mean, I heard the statistic, but I couldn't tell you the time frame. But it's a lot compared to your normal crypto asset because it's a currency. Interesting. So, before we break, anything else that maybe I should have asked, I didn't ask, or you thought I'd ask on the podcast?
Yeah, I think it's worth digging into Terra's stablecoin, UST. So Terra's focus is really on improving use cases and bridging UST to the real world via fintech apps. And, they are also an algorithmic stable. But I think the Terra ecosystem is really, really focused on integrations with real world applications. And so being able to spend UST at a grocery store, at a retail location, and have a reason to hold it. I think it's like valuable to see companies not only prizing, the mathematics and behavioral economics behind maintaining peg stability, but also shoring up demand and making sure that there's a place to take the currency. I think that's a super admirable goal. It remains to be seen whether UST will gain really wide adoption, either in the real world or, in the cryptoverse. But I think it's a very strong first step to think about demand and integrations before you consider the mathematical superiority of any peg mechanism. I think the kind of like hidden secret here is as long as people want the thing and want to hold the thing and use the thing, it matters less what the stability mechanism is, because if we all have faith that the US dollar is going to retain value, then we're going to keep using it. There's going to continue to be demand for the US dollar.
Right. Well, to date, USDT has proven that, because despite the fact that they've, after their disclosure, they're still maintaining the peg. Remains to be seen what else is involved in that, but they've certainly maintained it for now, despite what you think would be a real confidence hit. Maybe I don't think that story is fully played out, though. Obviously.
Yeah.
Back to Terra. What is their mechanism for maintaining the peg?
So UST is a similar algorithmic stable that issues Luna against against the stablecoin. And so Luna is the equity share of the Terra ecosystem. And so when the price is below $1, it's redeemed for a mix of collateral and Luna. And so Luna really is the equity is kind of used to buy and sell UST to maintain around the peg.
Great. Well, I'm glad you brought that out because it actually came up in my research, but I never got to it. So thanks. So if people want to find out more about you, read your stuff, where can they find you?
Twitter is great. I'm at JONWU_.
Excellent. Well, John, thanks so much for coming on the podcast.
Hey, thanks so much for having me.